Hey guys, I'm here. I'm just waiting a few more minutes, letting some more people join. AR, are you on? Do you have that? Can you hear me? Can you shoot me that the chart with the models on it? I forgot to pull Nick's script. Yeah, I'm going to share all the PVI stuff with you guys with the newer members. So if you got questions, it'll be a great time to ask. All right, we'll give it one more minute. You guys are watching the 5-minute ES futures. All right. Nick, T-Mac, Terry. Is this all Discord? Do we got any non-ITG people on? If you would type in chat, if you don't mind. It doesn't do any good. The Discord, the guys that are in our Discord hear me all day anyways. All right, T-Mac, I'll explain it. We got about 30 folks, so Nick, too loud? I don't know if I can turn down the volume. Nice. ITG is Independent Traders Guild. It's just a group of a few hundred folks that everybody's got different systems, and we collaborate and we build models and back tests and trading systems and help each other trade. Just wait till after the I mean, again, we're a Discord, so but we can give it to you after we do YouTube. All right, 7:15, 7:16. My time, 9:16. I just want to get started. I know we talked about 9:30. My wife booked a couples massage, and I wasn't sure what time I was going to make it home. So, okay. First and foremost, I'm going to click back over. We're going to go to. You might or might not be here for the PVI system, but this is the process that I run. It's a way to sell credit spreads, and I call them credit spreads. We don't do iron condors. We want to enter when the market's favorable for us to enter trades, and the market's not always favorable on both sides. From there, and I've been doing this for a long time. I don't need to go into my background. I can talk to individuals after the fact. I'm pulling up Reddit right now so I can look and see what kind of questions we had. Dr. Hudakris, big event. Yeah, and I'm going to go through the trades that I've made so far and explain it. But bottom line is this is PVI for SPX this week. 55.12 on the top side and 51.82. And the reason why it's a little bit wider It's actually probably about equidistant as it was last week, but it seems like it's real far out, and that's because we got CPI tomorrow, we got FOMC tomorrow, and then we got PPI on Wednesday. Bro, he's being a smartass. Anywho, so we go through. The model process to develop PVI looks like this. And I shared this on Reddit, so you guys have already seen it. I'll just run through it real quick. On the high side, this is three models. There's three institutional algorithms that I run, that I used when I was a hedge fund manager, a portfolio manager for 680 million fund. But there's three models that are suggesting that SPX is going to stop between 54.10 and 54.20. There's two models that's going to say it's the next 10 points. There's three models. So here's a little aggressive cluster at the low end of the inside of the SPX high for this week. If you look up here, here's the biggest tower. There's five models that are saying we're going to make it to 5,000, 5,500, 54.90, 5,500. This one is called an outlier. It is 2 times the expected move. So when I present this stuff and share it with you guys on Reddit, you need to realize when the expected move, the expected move's down in here, but 2 times the EM is right here. When this is detached from the pyramid, or it's detached from the pyramid, these are outliers, and we very, very, very less than 1% of the time we hit them. They're also important because if you feel like the market's going to rocket on or just absolutely free fall on FOMC, say CPI is bad tomorrow, and then you're worried that FOMC is going to be bad as well, and you're like, I kind of need to take some lottos. Well, this is a real good lotto because if the market falls all the way through here, it's usually going to get hung up right here because this is supporting all the other models. Now, the low end has something the high end doesn't have. The low end has an outlier on the inside, the high side of the low for the week. That's 52.70 and 52.80. So in the event that CPI, we run it up into CPI and we drop tomorrow, shows no loss. If we drop on tomorrow afternoon and we close lower tomorrow afternoon and the wheels look like they're falling off, this is a great debit spread to have on. With debit spreads, if you're buying debit spreads on a Wednesday that expire on Friday, if you buy wider than 5 wide, you're wasting money. A 5 wide debit spread, and you try not to pay more than $1.25, but there's a secret to it if you know how to scalp. If you know how to scalp, then you can enter your long early, and if the market's dropping, then you can sell your short. Let's say you enter at 52.80 and you sell at 52.75, so you got a 5 wide. If you enter it right with good timing, you can actually get paid more money for your 52.75s than you paid for your 52.80, and that would be what we call a ghetto spread, where we're in a debit spread, but we got paid a credit to get in the debit spread. And we did so because we knew how to scalp to get into it. Does that make sense to everybody? So on the low end, the 6 models are all lining up. They're all different math, guys. Fibonacci, open interest, expected move, 2 times expected move, option, I said open interest. There's volatility components in here. There's 26 different. They're not the same. But just know this, whether you're looking at models, whether you're looking at just a standard stock chart, indicators, VWAP, bands, levels, moving averages, Bollinger Bands, RSI, stochastics, MACD. It doesn't matter what you're looking at. It was formed or comprised of price, volume, and time. Those 3. You got to know that. Now, the variances of price, volume, and time. Is it just price? That would be a candle. Is it just, the clock, the time of day? Is it 2 of the 3? Is it all 3 of them? And if it is all 3 of them, which one's weighted more heavily? Keltner channels have an ATR component to them that Bollinger Bands don't have. They're both a way to identify price action, candlesticks and price action as too far, too fast, overbought, oversold on the actual chart rather than being down bottom as an oscillator. Like we have oscillators. So again, I could put Bollinger Bands up here, Keltner channels, envelopes, anything you want to get up and create, you can create it, but everything is based off price, volume, and time. And anybody that would tell you otherwise, they're blowing smoke. That's why there is no perfect indicator. If there was a perfect indicator, hell, we'd all use it. And the people that created it probably wouldn't sell it. There is no perfect indicator. There are indicators that can give you alpha. We used to have a contributor that would say all models are useless, but some matter, or something like that. Somebody can correct me on Discord or in YouTube, doesn't matter. So this is the PVI system. So we got the 26 models, and we go through the 26 models to come up with these two. This is the end state for this week. The mid state for this week is to come up with these other models, and I'll post the spreadsheet because I know some of you guys just want to screenshot the spreadsheet. I'll post the spreadsheet in Reddit. I don't mind. But this is where they came out for this week on the high side. Baseline's at 54.97. Let's see if I can get this. I have lost my... Hold on, I'm trying to drag something up there. What the hell? Tough when you got so many screens. So, I'm just going to try and put this over here because I don't have OMs. So baseline's at 54.97, and 54.97 puts us in one of the five. So the baseline model we know is one of these five models. One of these five models is actual our baseline model. It is an algorithmic component. It is not, we don't manually calculate. I mean, it's a standalone. And then you got, shit, you can't even get them apart. PWG and well, clearly you know these two are the same, right? You can't even separate them. All models are wrong, some are useful. Thanks, Nick. You're freaking king. Okay, these two are at 55.08. 55.08. So these two models, well, what do you see right here? 5500, 5510. How many models make up that candle? Two of them. Well, which models are they? PWG and auto. Baseline is one of these five. PVI is not going to be on here because PVI is calculated. It's not standalone. So PVI is all the way up here at 5512, just above the last model. And again, I don't use this model to predict PVI. PVI is a mathematically formulated system. I create PVI and I get a number, and then I go to work on the number. Where is the models? Where are PWG, auto, and baseline? For the last 2 weeks, PVI has been inside some of the models. Not normal, but it has been because it was telling me the volatility component that PVI uses is not picked up by PWG or the auto model, which have volatility components to it. Okay, so that's what it looks like, and here are the ranges for the week. So here's PVI low, 51.82. The highs at 55.12. 2 stars just indicates that's a 52-week high. Here's the previous close. This is the auto model. This is the PWG model, which is our main volatility model. And this is our baseline, which is our main options model. And this one here is just telling us that our baseline model that goes in, not this model. The baseline models are higher than the PWG models. And so again, some of the questions that came up on Reddit, they were like, wait a minute, if this is the aqua, 5497 is not higher than 5508, so that should be orange. So again, this is here for me and for ITG members. It's just a quick reference guide for us to see the options have priced in all volatility. So going to Nick T-Mac's question right there, do any of the models account for volatility contracting after the news? Yes and no. The first is this. The options model is the widest for the week. And that means the options models, they have all the volatility components embedded in them. And they have them priced. So when you look at it like this, if you see options, you just know that we're under VIX, under volatility, and the options have the premium for the event. And the options are pretty juiced up this week. So if you look over on, I'm not going to be able to pull this. It's on another screen, another computer. But if you look at the 5510, which is the strike underneath this, the 5510 calls, they're trading at 30 by 45 cents right now. There's no premium on the high side. If you go down to the 5185s or the 5180s, they're now trading at 55 cents. So they're almost, actually the puts are still almost 2 to 1 over the call side. So the options, just know you're not getting anything. If you go to last week or previous week, we were all orange, which meant options were not pricing in the volatility movement. They were not even priced in a 1 expected move, let alone a 2 expected move. So when you see a lot of orange here or orange in your favorite, let's say you're a NASDAQ trader, NDX, NQ, and QQQ are all orange, then that might be one, and you're like, whether you're bullish or not, you're expecting volatility to move, and the options market has not priced in as much move as the volatility models are suggesting. So you're thinking about long straddle, long strangle for the week, whereas up here you're thinking about short straddle, short strangle for the week. Who the hell's going to short strangle or do short straddle an ES or an SPX in front of CPI, FOMC, and PPI? I mean, shit, you might as well go to Vegas. Because that's not a smart trade. All right, NQ's pushing. We're back up 58, just FYI. Okay, so these are the models, and I'm going to post this on Reddit. Now, you guys got to understand, SPX, ES, I don't do a lot with SPY, but it's in the mix. So these top 6 and then VIX are 26 models. There's a lot of analysis done on those that are not done on Amazon or Meta or ExxonMobil. And these are just random. I used to use a lot of these when I ran my fund, and we'd sell a lot of premium on them, monthly premium, and they've just kind of been with me for a long time, and so we've expanded. Chevron, ExxonMobil are a pairs trade. We have that on our options pricing model. Home Depot and Lowe's, another pairs trade. We have it on our options pricing model. With NVIDIA, going through their split, 10 for 1. They've lost their Momo, their mojo, and so they're no longer going to be the market leader, despite being the 3rd largest company in the world. But is what it is. That was their choice, and that's what they did. So going back to PVI, that's the process. So that everybody kind of understands who, what, where, when, why, how it works, why it works, and how it's derived. Sometimes it's easier to hear it for myself. So here, let me scale out just a little bit. I got the 50, red, white, blue, 50, 100, 200-day moving averages sitting here for you. And then we're going to get into the weekly some SD box. And again, it's the supply demand. I got this on from the other night, huh? So here I got to drill down to a 1 hour chart, and this is how the week's starting off looking. So we got models, and we got the 50-day moving average red working through the lower models. So we know there's some support here. Oh, the other thing I need to show is the orange lines. So these 3 orange lines, guys, it's just something that I do. They're called gravity points. It's a proprietary thing that I've used forever. Normally when you see gravity points, they help you identify trends and price action. Where can we expect price to gravitate towards? And where can we expect it to hold? And where can we expect it to repel? And so the slope of the gravity points, their arrangement, like right now we got A crossing down through C. The orange lines are where the gravity points were over the weekend. People ask me, how do I know if I hedge on Wednesday or Thursday or Tuesday? I want to see where the actual gravity points are on the daily chart relative to where they were on the weekend, right? Again, on the weekend, what do? Spend 12 hours, build a plan, build a contingency, build an alternate, build a abort criteria, build out everything on the weekend. So when price action happens, you're like, oh, it's scenario C. Oh, it's scenario A. Oh, it's a snooze fest week. We're going to collect premium, not have to do anything. Or it's a grab the oh shit handle in the car and hold on because we're going through a steep turn. But that's what the gravity points are there for. I'm going to take them off because I only use these. These are only configured for daily charts. And when I drill down to the hour, I don't want to see those dots because they don't matter. What matters is the orange lines because this is where they were on Sunday over the weekend. So that said, now we go into pulling the weekly. And this is a lot of information, pulling the weekly. And so I put it on and then I like to take it back off. The biggest one is, where is our weekly supply demand box? And it's right here. And I'm going to take it off. And the reason why there's magic here is we almost hit it this morning and we broke it this afternoon into the close today. This is SPX, so it's not updating. But just know, guys, we have a 99, Nick, I'm going to make it up, but we have over a 99.7% chance every week to get above weekly supply or below weekly demand. So last week, we got below demand and we got back above supply. Previous week, we opened on a Monday, or we opened on a Tuesday short week, and then Wednesday we dropped down below weekly demand, and we sold the rest of the week. So in the event that the market breaks out, you see where it is. In the event that the market breaks underneath demand, you're thinking, I need to put on long puts. I need negative, I don't want to say negative delta. I need trades that are going to benefit from the market moving lower. Anytime the market breaks above weekly supply, like it did last Wednesday at the open, what happened after Wednesday? We went long. Guys, you can do this on every stock that you have. We have these weekly levels that show up, and they're important. So much that if you go and put on ES, if you go look at the weekly on ES today, here's our weekly ES chart. That's the daily. Let me go down to the 4 hour. That's what she looked like today. Let's go to the 30 minute. You can see the color of the candles, one-time framing. Again, buy trigger green, sell trigger red. Boom, sell trigger, we came down. We hit 5 a.m. this morning. We hit an inflection point, our zone, harmonic zone, rotated back up, hit another harmonic zone. The first harmonic zone above buy trigger, the first harmonic zone below buy trigger, and the market's mean reverting in here. Why? This was yesterday. There was no conviction yesterday. Why? Everybody kept saying, market's not going to break out before Wednesday. And then what happened today? Bam. On the open, We're at the lows, we're at weekly demand, and we finished here. Crazy part is a demand. It's a model. It's not drawn. But to go from weekly demand to supply in a day, it's rare. We did it last week as well. I don't think we did it actually we didn't do it on ES last week. We did it on NQ. We did it on this day, previous week. So Thursday on the 23rd of May, again, we opened here, and by 1 o'clock we were here. Weekly supply, weekly demand. And again, I talk about the box all the time. When we're in the box, theta rules. And how the market moves on Monday and Tuesday, we stay in the box. Most people have enough money to get in and out of their trades and be profitable. So I will pull this up. And this is yesterday and today. So premiums pointed lower for the early part of the week. We sold an interim call credit spread, CCS, for 120. I sold the 54.80s. Remember, PVI was 55.12. Why did I sell inside? Why did I pick that? That's another discussion for another day. But I knew with premiums pointing lower, we were going to have an opportunity to get out of these calls. And then I sold some PCS. If I don't put anything in here, it's not a back ratio. 1-to-1, I sold 5, I bought 5. So I bought 5 at 75, 50, 80s, 51, 80s, 100 wide. I sold 5 for 240. And then yesterday afternoon, I covered 4 of them. You can see I covered 4 right here. The only edit to the change is that I'm adding EST to the trading confirms because this trading is Interactive Brokers and it's my time, which is Mountain Standard Time. So again, I sold it 240 and I covered it 110. I covered it 110 because we didn't do what we needed to do in a daily situation. There's a certain scenario where we're supposed to go touch a box, a level, and we did not touch it. So I told our Discord that we were going to come down and touch it overnight. The call was 53, 55 AR. So I said we were going to get down to 53, 55, and we were at 53, 67 yesterday afternoon. And so I covered them, and this morning, as soon as at 5 o'clock my time, I'm up. I got coffee. I was already trading. Market pushed down. I resold 2 of those 4 for 160, an extra 50 cents. And then the market moved lower. We were at weekly demand. What do we do at weekly demand? Sometimes I put on a call debit spread. Well, today I took off my these interim call credit spreads. Sold at 135 and I took them off at $1. Is 35 cents a lot? No, except for the fact that those 54.80s went to $1.80 today. I didn't resell them. And then as we went higher during the day, I covered, I took 1 more off. So now I'm sitting in a 5-1 call credit spread. And I'm sitting in a 5-1 put credit spread. And if you go through and calculate it up, you can figure how much premium you have. I don't do that. I don't do that, but I don't worry about it. Again, I've been trading PVI system for so long, I don't worry about it. But I already know here's a $1.70 trade, $1.65 trade, and then I took some off. So that $1.65, and then I put it back on. So there was an extra 50 cents in there. So it might be, I might have $1.80 premium on the put side. And then the call side, I covered for 35 cents. Well, people are like, well, why the hell did you do that? Because I wanted these bad boys right here paid for. I have no debit. I've already made money this week. If I don't make another trade and CPI and FOMC, they go flat, I'll sell 0DD calls against them, or I'll sell Friday against them if we move, but we're going to move. We know we're going to move on CPI. So now I've got free long delta on the call side. I've got free long on the put side. And again, to hedge one call contract takes 2 ES futures contracts. So literally I could say, well, I don't care about 54.80. I'll go long 2 ES at 54.70, and that's 100% hedged. I don't have to worry about it. And I'd love for that to happen, because if that does happen, these calls are going to go to about 35 cents. But more importantly, somewhere in the middle, about a 50 wide, I'm going to be able to sell those puppies for about $3 or $4. And the same thing on the put side. And that's why you want to get in on Monday or Sunday night. Get in Sunday night, Monday, get a position. Build your position, then start peeling your position. And I think Dr. Hudacris was asking about that on Reddit. Get out. Get in, get your profit, and get out. But don't get out your longs. Recycle your longs. Scalp your shorts. Sell for 240, cover for 210. Sell back for 230, cover for 180. Now don't sell for 150 and cover for 220. So you got to know how to trade. And again, I don't put all these miscellaneous trades in the annual performance Excel spreadsheet, because again, it's not realistic. So I'll take again 5 trades, and if again this is an interim, if I can sell 55 12s, 55 10s, and I can get $3 premium tomorrow because FOMC, we rip on CPI or we rip on FOMC, then that's going to be the trade that goes into my Excel spreadsheet, because that's going to be my live trade. But I'm not under pressure to go post numbers. I got numbers, if that makes sense. So I just want to put that up there so that guys kind of see. I don't sit in the trades. I mean, I do, but sometimes I scalp them, if that makes sense. There were no other questions that I saw in Reddit. So anybody's got questions on YouTube on the stream, ask. I mean, that's what we're here doing. Now, in the process, I've marked all-time high. And then in the process, I'm going to go back and I'm going to put up this throw-up diagram, because I can't get rid of this. I guess I can drop down to a shorter time frame and zoom. But I'm going to talk through the hedge real quick. So here's my hedge. Monday, Tuesday. First of all, did we close Monday and Tuesday above weekly supply? No. Did we close Monday, Tuesday below weekly demand? No. We need to close both days on the outside of the box for me to start worrying about PVI. Now, I know the event's coming tomorrow. That's why I wanted to get money. I want to get paid. I want to get, I don't know, maybe $1,100, $1,200 in premium already in the bank. And then tomorrow, instead of having to worry about 5 contracts, if we spike up tomorrow, I'm going to sell one. And if I can get $3 for it, great. Now, for PVI, for ITG members, they know this, that if PVI is more than double what you expected on the weekend, we advise people not to sell PVI. We advise people, let's say PVI comes in and you say, I'm going to sell PVI as soon as it hits $1.35. And tomorrow CPI, we gap open huge, and you don't have interactive brokers behind the curve. And so you can't trade until the opening bell. And when we open tomorrow, you're expecting PVI to be around 135, but we open tomorrow and PVI's $3. You march your ass up the option chain to find $1.85 or $2.25, and you go sell up here, and you got about a 99.7% chance of profiting. PVI's breached by 100 points 2 times in the last decade plus. There's too many models in it, guys. There's too many what ifs. Volatility, Fibonacci, open interest, gamma. There's too many shelves. There's too many checks and balances in the system for it to get massively run over often. It breaches. We have 3 closing breaches a year. That's a 97 or a 95% win rate. Well, if you got 95% up here and you got 95% down here, add them together, and then you got to subtract. You got to divide by 2, because You can't lose on both of them. I mean, the market can't be here and up here at the same time on Friday. It's just impossible, right? So whichever side you lose on, the other side is an embedded hedge. So you take your 95% and now you take off 2.5% because you ain't losing that one if this one's getting challenged. So now you start talking about a 97.5% trade, and that's how it works. On weeks we don't have huge event through the week, and we open up Monday, and it's looking bullish, then I tell people let's get into a back ratio. Let's get 5 longs, maybe 3 shorts or 4 shorts against it. And as soon as we breach weekly supply, we go ahead and sell one more contract. And then if we move up to weekly R2, we sell a second contract. Now, if we go 5 to 5 on Monday and we're not expecting an event that week, and all of a sudden Monday we go up to weekly supply on Monday, we immediately go, as soon as we breach this on a 30-minute or a 1 hour or wherever you are, however close PVI is, where is PVI relative to the other 3 models? Where is it relative to the gravity points? The 50, 100, 200-day moving average. You can't control all that. You can't script it. But if we're close and you're nervous, then we immediately, as soon as we cross weekly supply, we immediately buy a 5 or a 10 wide call debit spread at weekly R2. Now here's the secret sauce. When I put that weekly debit spread on, is that going to take away from my premium? Yes. Is it going to take all my premium? No. If it's going to take all your premium, you're better off cutting that trade. Don't ever pay more for a hedge than your initial trade. If you do, you just flip the whole damn thing upside down, and now you're you're inversing yourself, which for some of you futures traders, that's probably a good thing to do. Flip your damn screen upside down and you'll be more successful. But with PVI, that doesn't work. So what I do is I put on a 5 or a 10 wide debit spread at weekly R2, and the second we hit weekly R3, if it's on Wednesday, I take profit. And the reason why is you go back to, I can't go back on that one. I gotta minimize this. You gotta go back, but you go look and see, well shit, if I take that off, I can't see it anyways. You go back to these and you look and see how many times we got to weekly R3. And we stopped. Let me see if I can put the weeklies on. I usually have a script, but I killed it. Sorry. Freaking vet, getting a damn massage. Running in late, trying to get his chart set up. Watch how many times we hit weekly R2. Look at how many times. Weekly supply, weekly R2. Did we make it R3? No. How about 3 weeks ago? Weekly supply, weekly R2. Look where PVI is. PVI was inside weekly R3. Gambler. But hey, I do the models. That's what I'm telling you. Guys, we're not trying to do 100% win rate. If I wanted 100% win rate, I'd be way outside of everything every week, and we get no premium. I want to have $50,000 at risk every week in the model portfolio, and I want to make $100,000 from it. So if I look at what my risk is relative to how much money I'm putting on the table, I'm making 200% a year. Well, go out there and say, hey, I make 200% a year. How fast are you going to get laughed off the stage? A lot. I don't care, but I don't want to sit there and argue with people telling me it's not possible. I've done this publicly, and I got audited returns on this same system from FINRA, NASD, Hawaii, Arizona, and Georgia, state auditors. That's what you got to do if you're running an RIA firm or you're with a broker-dealer in the FINRA and the old NASD world. But here, weekly R3, never touched it. Weekly R3, never touched it. Weekly S2, we touched it. We never got to weekly I don't have weekly S3 on there. And again, I tell the members, ITG members, get in there and do your homework. Look at that. Never touch weekly S3. Here, we got supply, R2, weekly R3. We touched it, we breached it, and we came all the way back to supply on Thursday. And then what happened to Friday? We ripped, and this yellow is PWG level for that week. How about this one? Monday. What did we do on Monday? We opened up right here. Did we get below weekly supply on Monday? Yes. What I just tell y'all, if we get below weekly demand on a Monday, think about weekly S2. We went S2 all the way to S3 on Tuesday. So if we hit it on Tuesday, am I interested in, I don't know what happened this week. Am I interested? Oh, that was, this was this the Iran, Israel launching on Iran week? I think it was. April 5th, 17th. AR, do you remember? It probably was. So we breached PWG. And again, I wrote this up as a breach week. We didn't breach it, but ES was underneath the equivalent of 49.29. And then what happened? It was, false alarm Friday morning, and then they ripped it all the way back up to the PWG level. And again, the models matter. Look at this. We run right to the PWG model and stop. So if you're in a spot where you can take profit, where you get a debit spread, again, weekly S2, weekly R3, take profit. Goes back to weekly supply. The other thing I do is in the event that Monday and Tuesday both close below weekly demand, I roll down my calls. I roll them down to probably weekly R2, sometimes sell target 1, depending. I rolled this week big time. There's systems. If you got a 4-day week, where's the 4-day week in here? I know there's one. Oh, we just had one. If you got a 4-day week, the Monday, Tuesday rules don't apply. 4-day weeks will absolutely kill you. Right? Here's one. Close below weekly demand. Close below weekly demand. If you roll down your calls, because this was a Tuesday and a Wednesday, you roll down your calls. Oh, this was Good Friday. You were clenching. We don't need to clench. Here we got a breach. We got our one breach of the year, officially RTH breach on a Thursday. And I don't even I don't even remember having major hedges on that week. So again, it's just a process, guys. All right, I know the system. I don't necessarily need to teach anymore. I need to spend time asking you guys what questions you have and how it works. How can I help you guys? Or we go to stock charts and play Stump the Chump. But I want to do that with non-ITG members, because you other guys get 8 hours a day for questions. Anybody? Blake? Fear and Loathing? Lost Vega. I love it. No stocks are off limits. Y'all just give me the ticker, and we can stock chart them. Going back to intraday stock chart stuff, I have a bunch of proprietary stuff, but what I share with our ITG members is that we work a momentum oscillator, and it is a dual duration. And again, it's just standard oscillator that you would have. It identifies momentum in a block share capacity, really more institutional momentum. And right now, SPX, we are overbought. The blue and white lines are overbought. They're above the red 75 line. And then the red dots are weekly. And so we're overbought on the daily and the weekly, going into making an all-time high today. Overbought on both of these. And we're nowhere near, we're right at weekly supply demand box. So very good chance we're going to be well back below 5285 is the middle gravity point from this weekend. And then if I go back to this 5285, here's my outlier at 5280. So you're like, wait a minute, I got a gravity point at 5285, 5284. I've got an outlier at 5270 to 5280. In the event that one of those news is bad tomorrow, where the hell do you think we're going to? Right here, and then we're going to start correcting the overbought on the daily and the weekly. Okay, weekly supply is TMAC. It's derived. It's a model. It's a script. That's fine. 2 times standard deviation of volatility. You do what you do. Yeah, again, so this is what we do. Let me see if I can. Hate to post all this on there. But if you go to invite only, here's ITG. We hadn't made this one available yet. This is the Momo indicator. I can go through them all. I have session ranges that I can't protect them. That's why we don't share them, because somebody wrote a script in Thinkorswim way back in the day, and I kicked them out of the Discord because I don't want it. I don't want my stuff out publicly. Again, it's scalable, but it ain't scalable if, what was that bull bear market that had like 85,000 members? I mean, if they've got it and they're trading off our levels, we're screwed. We got our gravity points, harmonic zones getting ready to be released to our group this week. I'll show that later. Slingshot's a day trading indicator that I have on a 5-minute test. ITG trend is down here at the bottom, and all it is, and look, let's pull up ITG trend. So here's the trend on a 15-minute chart, and I highly, highly recommend. I don't know why the dots are off. I guess I pulled the script from. I pulled the script from another chart. But here's the script. In the event that you're basically the color, the background color of the trend is your trend. And if you're fading it, you're offsides. That simple. Don't make it complex. So on a 15-minute ES today, let's go to Friday. On a 15-minute ES Friday, we're red and we're bottoming. This is a lagging indicator. This is not going to tell you when, except for the fact that if there's dots, then the red trend is not straight down. Did we get a green? So here today, we got a 1 hour, or this is 15-minute. At 10:15 this morning, we started higher. We're solid green on the 15-minute, and we're one-time framing up. So what are you doing here? You should be selling calls. Let's go back to 10:15. So right here today, this is what we have in front of us at 10:15 this morning. So over here somewhere was yesterday's lows. Let's not worry about it. We made a low a day, ETH, overnight low at 5:15 this morning, and then we came down here at 10 o'clock. Did we take out that low? No, we didn't. I'm going to go to 1. Yeah, and I talk real fast too, Tyler. And it's just, again, guys, I've been trading since 1987. And I've been full-time in this since 2000. Well, really 1996, 97. I was teaching day trading seminars around the country, teaching people how to day trade way back when. Got my millions in the 90s. My first million, blew it. Got overzealous with short-term options at a bad time. Got a big corrective storm in my life. And then 2001 and 2, I was dusting myself off after the tech crash and started back in the world of, got my CFP, went through the CFA. I got my first 2 CFA pass. I just never finished the third one. So it's a lot. And the only reason it's a lot is we are an independent group of collaborative traders. ITG is not me. I do PVI, I do the option pricing model, and I teach how I do futures. We got plenty of contributors that do futures a different way. We have a delta channel. We have a theta channel. We have a butterfly channel, sells 112s. And we got contributors that do this stuff. But anyways, we didn't make an overnight low at the AM lows, and we flipped green right here early. And so we were leaning long into the open because the trend was giving us a green signal. I do not use Momo on a daily or intraday, just FYI. It's a daily indicator for me. But I just want to see, are we overbought or oversold? So the market's moving up, and again, the indicator, depending on your time frame, is just telling you when we start to see dots from a green trend, that's when you start walking your stops up. Why are we seeing dots? Well, we're getting right into VWAP. Again, the clock and all is a little bit different. Then we open the market, we come back down, we test the lows, which is right at a harmonic level zone. But it's a higher low than we hit pre-market, and then the market lifted. So again, once the market lifted, we're in RTH, and we're green on our trend indicator. We get a dot, and that's telling us, okay, somebody's starting to slow down. The dot basically tells us institutions are taking some of their money back. Check the internals. Check the Rusty. Check the Dow. Check the ES. Check the NQ. Check all of them to make sure, because something in here is telling us it's not smooth skies ahead, right? So be careful. Doesn't mean to go short. Okay, go short is if we flip green to red, and then we got to go from straight green to straight red. I don't know. Yeah, we got one right here. Straight green to straight red, and then we rocketed. Then this was overnight. So in the middle of the night. You're not going to use a 15-minute chart in the middle of the night and expect to scalp. But anyways, if it happens, it's typically a sell program kicks in. But it's just an indicator. If it works for you, you use it. If it doesn't, you don't. I mean, it is what it is. And we came down today and we hit our levels. And our levels were money for us, taking smart trades off key levels. The blue and the yellow, that's just VWAP and 2 times standard deviation of VWAP. But for us to come down this morning and hit, if we put our weekly level on here, where'd we get to? We got right to weekly. We got right to weekly demand on NQ. No, on ES. This is yesterday. Anyhow, you get an idea for it. Again, we've been doing it for a long time. And there's a lot of contributors. The biggest thing I would tell everybody, if you're interested in joining, is this: stick in Reddit, ask questions, follow on Twitter, ask questions. Try to take some of the data that Blake, you're killing me. Try to take some of the data that we provide for free and try to generate some money. Go make $100 off the data. That's why we share it. Get profitable and be like, you know what, this is interesting. And then after you made a couple $100, then join for a month. But when you join for a month, join with an open mind that says, look, this is who I am. This is how I've traded. I'm going to work at getting better at what I'm trading. Don't walk in and be like, oh my God, you just walked into an all-you-can-eat buffet. It's a smorgasbord of all your favorite foods, and you sit down and you got fucking 5 plates of food in front of you, and it's all going to be cold before you eat. Don't do that, because you're going to get frustrated. It's too much. It's way too much. I mean, for me to kick out all this stuff and go through, the clock, internals, the relationship between the other markets, where the volatility is, where our gamma models are pointing us to, and all this other stuff in here. I mean, it's a lot. And people are like, how do you do it? I just have done it for a long, long time. You find your fit. You do. And so you work to get better at what you already have success with. And you will, because you're going to. Now, the warning I would tell everyone in here that's new is if you join the group after about a month or two, you're not going to be YOLO in trades. And if you have a big blow up, you have a massive loss, there's a reflection in the mirror. That's whose fault it is. Because you violated rules. I've lost $1 million in 6 weeks. In literally April 2000. I don't trade like that anymore. You're going to learn to trade with stops. You're going to learn what, return per unit of risk is going to be in trades, in options. That goes to the option pricing model. If nobody else got any other questions, I can kick out the Discord folks. I can go through the option pricing model. I don't think I can update it for tomorrow yet. I think Rick changed the code. But again, if you're a weekly trader, let me do this. I hate having such a big screen. If you're a weekly trader, we go on the weekends and I run this model, and this model pulls up every Greek and volatility component. If y'all don't mind, I'm going to do this while we're sitting here. Just so I can see where NQ is. Just so I can keep an eye on it, because I might have some trades on. So here is our option pricing model. This is the call side. And this was for today. So on today, you see the call side. The PVI is the columns you're interested in. 79, 79. This is just telling you that SPY and QQQ, they are equitably priced. There's no edge here. There's no edge here. 95, 94. They're evenly, the call and put options. Now, this is the delta. We run it off a delta. Why? Because we have a lot of people that trade delta neutral strategies. If I can get a delta neutral strategy in and get an income, a credit for selling that, that's a win. If I can make no money, but I end up with positive delta, that's a win. If you pay money to have a negative delta, you're a loser. You are a loser. If you can get a credit and have a positive delta, you're going to win 98% of your trades if you trade smart and you set it up. That's what we do. For instance, today, not the greatest, but today, Home Depot, 61 cents. Lowe's, 34 cents. Which one has more value? The lower number has more value. So what I do is I color code it. If it's blue, it's half the value of the index, ETF. So NVIDIA today, for the first time in 4 years, over 4 years, it was half the value. The NVIDIA calls were half the value of the QQQ calls. Well, who ran today? Apple. Apple was undervalued, 45 to 79. Apple was undervalued the QQQ and ran what? 7% today? 6% today? So what we're in the habit of doing, if it's red, it's more than 2 times the index ETF. If it's orange, it's more expensive. It's selling at a premium or it's trading at a premium. If it's white, it's trading at a discount. Think of par bonds, par being 100. If it's white, it's trading at 99, 99.5. If it's blue, it's trading below 99. It's like a steal. It's like if you've got a dividend stock that you own and you sell a covered call and the dividend is worth more money than the call, they get exercised automatically. That's what blues are. Reds, twice as expensive. So people are like, well, I want to get long Netflix. Okay, if your due diligence tells you Netflix is going up, great. This model is just telling you for you to play Netflix, you're paying twice as much as you're paying for the indexed ETF. It doesn't mean you don't trade Netflix. It just means you trade Netflix differently. How? You put on a debit spread. Why? Because if the 15 deltas are twice as expensive, the 10 deltas are going to be twice as expensive as well. And so now your risk is what? The differential, the debit. So what we often do is we often sell red, and we'll use the premiums to sell red to go buy some of the white stocks or the blue PVIs. That makes sense? That's the option pricing. I put it out every day. They go until Friday. They're Friday expirations. If and when we get to a spot where I've got a little bit more free time, then we, again, occasionally we'll run a leap system where we'll put trades up here 3 months out, 6 months out, and then leaps a year out, and probably the next 2 years strike, and then we'll go down and look at it. People are like, well, if we do have a big sell-off this fall, I'm expecting, if we do have a big sell-off, which stocks are you going to buy on the way back up when it starts to recover? I tell everybody, I don't know. And they're like, well, I'm going to buy Meta. Okay. Well, I'm going to buy Nvidia. Okay. I'm going to get in Tesla. Okay. Why? Because they like the company. Well, I don't like the company. I don't care about the company. These are tickers to me. I care about this. So if I had to buy a stock tomorrow, and this is what I'm looking at, guess which NASDAQ stock I'm buying? I'm buying Nvidia. Why? It's trading at a 2 times discount. It's trading at half the value of the QQQ. If the QQQ goes up 1% tomorrow on FOMC, is Nvidia going to go up? Yes, probably. And I can pay 50 cents instead of $1. But what you guys do in the world of options is you look over here and you're like, well, shoot. Let's get this one. Nvidia is trading at 41 cents and Google's trading at 28 cents, and they're both around 15 delta. So Google's cheaper. I mean, 41 is more than 28. And then I march your ass right over here and you're like, well, wait a minute. 47 is bigger than 36. So this is the secret sauce is already done for everybody. Now, we do have an OPM Edge. It's an app that it's in development. We ran into some snags. I got a new engineer in the process right now trying to resolve some programming issues. And if we have it, then it'll be able to run. Then it'll be able to run live, real time. I'm still paying for real time on all these, but we got to be careful because we can't have 300, 400 members doing unlimited API calls just because they want to keep tagging in their their option. Oh, well, what about the 20 delta? Oh, what about the what about the 50 delta? What about the 75 delta? Again, the way you trade leaps, and Dr. Poon, you'll get this down the road, but we trade leaps at a different strike, a different delta than we trade 3-month options, and we trade them different than we trade weekly. The reason these are here is because the 15 delta often by Tuesday, Wednesday is going to start to line up with where'd she go? My PVI spreadsheet. Anyway, it'll start to align with the spreadsheet. And as it aligns with the spreadsheet, then you go, okay, wait a minute. The PVI spreadsheet says, for instance, Netflix is not going above 665 this week. Oh, here it is. Oops. Netflix is going to what? The high end is 691. Well, if PVI is 691 and OPM is saying 665, you're not crazy. You don't necessarily want to sell it. How about this one? Microsoft is 435 on the call side, and Microsoft is 444. I don't think we're going to find any that have broken out yet. So I don't think we're going to find any OPM strikes that are above PVI. But in the event that we do find them that above PVI, the secret sauce is this, is if it's red and it's above PVI spreadsheet and it's a Thursday, guess what you do? We can sell the red because it's outside PVI, and then we can distribute that premium. So the last few weeks, we've had on the call side for NVIDIA, we've had $6, $7. Well, I mean, how many freaking calls at 34 cents and 88 cents and 41 cents and 37 cents, 78? If you got $7 of premium from one NVIDIA contract and you're able to go buy 8 of these contracts and the market moves up 1%, you got 8 times 15 delta long. You've got one NVIDIA 15 delta short. So if you get a little bit of credit, but you got a 9 to 1 delta, you got long 9 15 deltas, you're short 1 15 delta, and you got a credit for it, you bank. Is PVI weekly expected move? I'm not. Yeah, that's a tough one. PVI is everything. So yes, but yes, not only that. Not only that. But I meant, yeah, it is. I meant PVI has IV, RV, HV, stock implied volatility, and ratios that I have tweaked and spent 6 months moving it from monthly option expiration down to weekly option expiration. And I did so because we knew 0DTE was coming out and that was going to impact the markets. And if you can manage the 4 weeks, you're going to make a lot more premium than if you place one trade a month. And so you got less overnight risk. We got overnight risk for 4 nights. Whereas monthly, you're sitting there for a few weekends. And again, Russia, Ukraine, Israel, Iran. I mean, you start dealing with short delta, where you're in credit spreads of size 100 wide, over weeks, not days. It's stressful. And the premium differential, it's not worth it. You actually have a lower expectancy doing the monthlies than you do the weeklies. You have higher doing the weeklies than you do the dailies. And so that's why PVI is set at that 5-day model. If I found a daily model that was better than the weekly PVI, I'd trade it exclusively. But there's so much, because in the daily, there's not enough volatility component to really give you an edge. In the weekly, you've got in the monthly, you've got tons of volatility component, but you got a lot more time for a negative headline, a news event, a CPI, an FOMC, a minutes, an NFP. And so you got more time for markets to impact you, and the options market does not pay you. Folks always want to ask, why is NVIDIA cheap now? Because they're going to make the options look cheap, but institutions aren't playing NVIDIA options anymore. Because you're not going to get a 100-point move in NVIDIA. You're going to be lucky to get a 6-point move. And so pre-split, that was a 60-point move. And so even though the options appear cheaper, if that was $12.85, that would be a lot more than $4.10. Matter of fact, if that was $12.85 pre-split last week, that would have been about $7. And so when they split the stock by 10, they split the option by a lot more than that. And so you don't get paid to sell them. Institutions were the only ones, accredited investors, 7-figure accounts were really the only ones that could sell, 10 contracts of NVIDIA at, $1,100 of the institutions. It's not anymore because they split it. Microsoft did the same way. Amazon did the same way. Tesla did the same way. None of them have been the same since they split. Why? Because everybody and their brother can go play a $192 stock. And most portfolios can sell naked one Amazon put at $182, which you could not do when Amazon was $3,600. Amazon was $3,600. NVIDIA was $1,200. Crazy. All right, I've covered PVI, the process, hedging, some indicators, option pricing model. It's 10:30 East Coast, so I can answer questions to non-ITG members, and we'll go from there. Or I don't have to. We can call ready to break the huddle. No matters to me. Here's where we're set up for tomorrow, though. And again, if you guys want to copy these down, these levels are for Wednesday. It's still Tuesday, but this is the Globex. You'll see R2 is now up here, where R2 was at 228, and now R2 for tomorrow is all the way up at 19,355. Hey Nick, can I show him your chart? Do you mind? With permission? It might not be on. So let me do this. Hold on, let me do this. So the first thing, and this is not all inclusive, we got a couple more members that do this. Guys, this is PVI. And so GC, one of our owners, engineer, he pulls data from other, these are two GC models, more fib-based. But this is the weekly ranges for this week. So you see PVI is 55.12, 54.50, 54.56, 54.67, 54.70. So you start looking at the average. The average for PVI or for SPX is forecast to be around 54.70. And then Bob, there's two other members that are Nick and Bob, or two others that provide their ranges as well. We got a lot of people that do their ranges. So again, I just want everybody to know it's not me. None of these guys had ranges until most of these guys we met when I helped Andrew start Options Millionaire. He started it. I didn't help him start it. I didn't know him. I met him the first day and I said, hey, I'm a retired Army pilot. You're an Air Force pilot. I'll help you out, man. I had nothing to do. It was COVID, and I wasn't teaching. So I wasn't coaching football. And so I started helping him, but this is where I met all these guys. They have since started forming their own ranges. And so again, this is part in our weekly range system. And then Nick does an NQ for us. And this is Nick's, this is his NQ model. Let me see if I can Scale it in. Blow it up. So he does this with NQ. This is where we were Friday, over the weekend. But he's projecting that, was this today or tomorrow? Tomorrow morning, that this would be a confluence point for NQ to hit, which if you look over here, it's about 18,830, 18,850, somewhere in there. And this is the target for the bears. And then he's saying that we could turn around and flip back up and then tomorrow afternoon be up here at 19,400 for NQ. And these circles are circles of confluence based off some algorithms that he runs on NQ. Trade it, don't trade it, watch it, ignore it. It's your choice. I mean, ITG is literal a la carte investing. Find what works for you, find what you like, what you're passionate about, what complements your work life, your personal life, your dating life, your school life, your whatever life. Find systems that help you live life to the fullest and start generating money and earn while you learn. But don't come in and try to learn everything and do everything because you're going to lose at everything. I promise. And again, you can hear it time and time again, but sometimes it's not until your back's against the wall that you really learn. But based on his models, lower in the week, higher on Wednesday, towards the close on Wednesday, which is the 12th, higher on Thursday, and then maybe getting gutted on Friday. So if you see that, you're thinking, oh man, we get up here and my call credit spread starts getting clapped. I'm going to sell a whole bunch of put credit spreads right here under supply or under weekly demand. And then all of a sudden, Friday we flush and you are PHUCT, you're screwed. Don't do that. Talking to Bob earlier about kind of how I'm forecasting the market over the next few weeks. The ITG guys know this. And Bob echoed the same thing that two guys that are friends, colleagues, mentors, students. They're students of mine from way back when, but they manage ungodly sums of money. You know, for a sole proprietor to manage $2.4 billion is huge. And he's like, dude, you're too conservative. If your forecast plays out, it's not going to be orderly. So you're wrong. I'm like, okay. But again, I'm just showing you guys because we have a lot of this stuff. We don't post it out because our members trade it, and we don't want hundreds of people or thousands of people on Reddit, Theta Gang, especially after they dox me and ban me. But we don't want people front running our systems. And that's why we're kind of, there's a good chance I'm going to start streaming live one day a week. And if I do, I'm not sure what the chart's going to be. Obviously, it'll be NQ and ES. A split chart per se. But it won't be, I don't know what indicators I'm going to show. I will do a midweek YouTube like this, probably on Wednesday nights. But I know it doesn't help you guys to find out, where the weekly supply demand box are or is on a Tuesday or Wednesday or Thursday. In PVI, the trade's pretty much done. For the majority of us, we've already, most people have already made 60 to 80% on their PVI trades this week, and we're going into tomorrow with relatively low risk or no risk. And as soon as that 8:30 data drops in the morning, boom, sell one. Sell one for 16. Sell one for $8. Sell one for 16. If it goes to 22, sell one more. And then the 22 one cover if it gets back to 17. 22 to, if I can get 5 points credit on one contract, SPX, I'm out. I'll take it. That's a $500 win. But you guys load up where you want home runs. Well, if you got home runs, you're going to also strike out. So don't go to the investment plate, the trading plate in the world of baseball, and you're like, well, it's win or lose. I'm either going to strike out or hit a grand slam and win the game. That is not trading. That is not trading. And you'll never have consistency and be successful. So I just sit here and watch the 5-minute on NQ and ES. You'll see that we're above this zone. ES's zone is at sell trigger. NQ zone is just underneath buy trigger. And we've been there since Globex open. Both markets spiked higher. We moved higher. Both markets came down. We found a bottom at the same location. And both markets found a bottom. NQ was at the bottom of the zone. ES was in the middle of the zone. ES was at sell trigger. NQ was underneath buy trigger. Why? Don't know. Don't know why. But once, like now, Asia's open, and so now the Asian markets start to matter. So now we want to see how do the markets respond in Asia markets. And then at 3 a.m., Europe opens. 3 a.m. Eastern time. And then I want to see, is Europe higher than Asia? I mean, if Globex high is here, Asia high is here, and Europe's high is here, where do you think U.S. market's going to be? Well, if they're trending lower, we're going to continue lower into the U.S. market's open. There's tons of tips and hints to trade and things to look for. You're not going to get it all tonight. You don't need it all tonight. The Rusty's taken off. So we got small cap getting long. Right now, the Heikenashis are straight green with flat bottom on all three markets. And that is bullish. So, guys, that's it. Reddit folks, feel free to ask questions in that post for the rest of the week. I'll post trades in there that I take. Obviously, it'll be after the fact, but I don't have a problem posting it. I'll answer questions where I can without giving away too much secret sauce. Again, all the guys in here that are not just contributors, but guys that have been trading with us together for the last 3 years. A lot of them build their own models. A lot of them work their own system, and then they know it. They see it. They smell it. They taste it, and you're going to find more success when it's your model, because then you know the strengths and weaknesses of it. But you don't have to have a model to get started. You just got to have an idea of what do you want to do. We had somebody today asking, where do I go to learn so I can start making money? Well, shit. That's a generic. I mean, that's like walking on a car lot with 20,000 cars and every make and model and color, and you don't know what you want. Well, that's not going to be fun for the salesperson. You got to have an idea of what you're interested in doing. And you got to make sure your investment portfolio will allow it. You don't jump in PVI with more than 50%. I would recommend not more than 10 or 20% of your buying power, because you're going to have to hedge. And, it's Murphy's Law, right? The day one of you guys joins, you put on your first PVI trade, is going to be the day we breach. It's going to be the first week we breach. This is the model. This was, we didn't breach it intra-week, but this was Iran. This was Israel launching back at Iran, and we were breached on futures overnight. This was an actual intra-week breach to the upside, 55, 52, 54, but we closed 20 points underneath it. So if you hedged and you gave up all your credit, and then we came back down and we closed inside PVI, and you lost on your hedge, you stressed, and you made no money. Here's last year, 2023. Week 10 and week 11 are infamous for being the first week, the end of the first quarter, MOPEX, not end of quarter, first MOPEX, quarterly MOPEX. This is usually a breach week. And then the market typically trends until we hit summer. And then look, we breached June 16th, we breached intra-week June 30th, and we breached July 14th. We breached 3 times in 5 weeks. Like seriously, I mean, talk about buns of steel. People's sphincters were eating their whole bodies right here. It's a new diet. This was rough. But you'll survive. That's where we are. And the reason why is because through May, we have decreased volatility. And decreased volatility compresses the ranges. And when volatility starts to expand, we have PVI gets challenged. But when PVI gets challenged, I mean, look at the premiums. The premiums go up. 2,000. Look at this one. I mean, I was chicken little. I was chicken shit, not chicken little. No, I was on vacation, but it was $625 that week. I hope I didn't log in. I didn't get paid minimum wage for the hours. Go back to 22. Same thing. Week 10, 11. Week 11 we breached and closed. This week 3, biggest loss in 7 years. Almost 100 points. 397, 497. Low end. That's how you knew 22 was going to be a rough year. But week 11 breached, and then we trended, and then what happened? We breached again in June. Which week? Second week in June. Which week are we in right now? But this was MOPEX, June MOPEX. You see June 3rd, June 10th, June 17th. This was Friday expiration. We breached to the downside. Lower breach, top breach, lower breach. No more breaches the rest of the year. Do we keep trading? Yeah. I mean, look in here. We start dropping down. Start making $3,800 a week, $3,700 a week. And then down here, I've got the total premium received and the total P&L. The difference is how much money we made and how much money we gave back because we hedged. What I don't have this year on this script is total premium received minus the 3 breaches. Because that was a $50,000 loss if you did not hedge at all. Those of us, we were out on Wednesday. This was Russia, I think, invading Ukraine. Crazy how long it's been. Anyhow, guys, that's all I got. Again, stats for days. That's who we are, what we do. Right now, year to date, total premium receives $49,223, not including this week, and total take home is $46. So I've given back $3,200 in cutting trades early and leaving money on the table or hedging and not needing them. Because I hadn't needed any hedges because we haven't breached. All true. No losses yet. But is what it is. Again, you can make stats look sexy. I don't. I'm just posting up here what they are. And the way this works is the date, PVI high, low, the open for SPX on Monday, the close on Friday, long put, short put, how much money I got for my credit. Short call, long call, how much money I got for my call credit, how many number of contracts I traded, and then how much I received from the sale of those calls. BP usage is basically 5 times however wide it is. You see right here, we went a little bit higher. I accidentally sold ES, and I went wider than I was supposed to. So that pushed our BP usage up a little bit higher. Return on capital, if you got $50,000 at risk, we're averaging right now 4.7% per week on our return on capital. PVI wins, and this is the all-important one. How much money did we keep? I love this system. You get paid on Sunday night or Monday, you get $2,000. The better you are at your job, the more money you get to walk home with on Friday night at the end of the week. Now, you might get paid $3,200. You might get paid $3,200 up here. How much do you keep? It don't matter how much money you win in trading. How much do you take home? And how much money do you not lose? And I've been fortunate, very fortunate. People are like, there's no way you've won 100% of your trades for the last 2.5 years. Well, this spreadsheet has built every week, and I got 300 people in here that'll tell you, no shit, there he was. This is what he did. They've seen it. They've seen me walk through it. I don't have to impress anybody. Now, not everybody has these kind of returns. I don't have the returns. One of our contributors trades futures. He's got over $1 million in equity in his Apex, 20 Apex accounts. And they put him on probation right now. They're trying to find a way not to pay him. The dude's accounts are 40 days old, less than 40 days old. And he's generated over $1 million on 20 accounts. Do the math. 1 million divided by 20. Do the math. He's made some serious coin. $25,000 in each account. Anyhow, I don't trade as good as he does. Futures. He trades, again, he's the other CFP. We have 2 certified financial planners in our Discord. Both of us are contributors. Both of us get on stream and talk and teach different systems. What we know. If it works for you, great. If it doesn't work, that's okay. We're not perfect for everyone. We don't aim to be. We just do what we do. If we can help you, we'll help you. My biggest thing is getting your $99 first month, $125, $150 a month, getting your fee paid for. And I do that through PVI. I mean, every freaking week, you're paying for a year's worth of membership, If you're sitting on a, $300,000 account and you're struggling trading, I would tell you join and learn to do PVI, because that's how much money, we made last year. This is how much money we're up this year with no losses. And I'm an open book. I mean, I share my IBKR trading confirms in Discord. I post them as soon as I trade them. So it ain't like I go back on Friday and I go make up trades that happened last Tuesday. These guys see the trades all the time, and we talk about it all the time. I alert them. Is it perfect? No. It's just a good system. And it's got good risk, great returns per unit of risk. And a big part of it is because of the work that goes into it before we kick out the numbers. The 10 to 12 hours on Friday night, Saturday, and Sunday. And once you've done the work, then you just got to show up, and the market's going to be in your favor probably 90% of your time. The other 10% of the time, the more competent and proficient you are at hedging, at seeing the market, at knowing where your data was, and trading futures, the more money you're going to keep, or the less money you're just going to absolutely give away. That's why I don't use stops, and that's why I don't roll like Scotty Smith does to, next week. I don't want to take a trade that the market says was a no-go this week and roll it into next week when I have no data for next week, because then you've rolled into a trade and you're 100% reliant on the market to save your ass, and you've done no homework. You just double down and you have no idea what the rules are, because the rules are going to change for next week. Next week's got different events. Next week's got different announcements. Next week's got different premiums, different strikes. But you just gave your money all in for next week, and you don't know, you're all in at the poker table and you don't even know what the game is, let alone the rules. That's stupid. That's what people that trade, they martingale. Well, there's a reason why not everybody in the world goes in martingales to millions of dollars, because it doesn't work. Because most people get stopped out. They hit their abort criteria before. And in trading, you're blown up. Don't do that. Get some base hits going. Earn money, earn income while you're learning, while you're in a community that's supporting you, coaching you, teaching you, mentoring you, helping you, answering questions. Stand on their shoulders. So that's ITG in a nutshell, guys. It ain't perfect, and none of us are. We do our best, and we're living, learning, and growing together. And we don't do drama. So leave your religion, leave your politics, Leave your bias and any racism and hatred and whatever else. Leave that shit out to social media or wherever, fake book or whatever else you want to post it on. But don't bring it in our house because I'll stomp your ass if you do that. I'm the only one that can get political in ITG and get away with it because I got the microphone. All right, guys, I'm out. Peace, love. Y'all be good.